Practice. Chapter 1. Introduction to Banking. Part 1. Riaz Notes. Meaning of bank. Riaz Notes. A bank is a financial institution that accepts deposits from the public, provides credit to individuals and businesses, and offers services like savings accounts, loans, and currency exchange. The word bank comes from the Italian word banca, meaning bench, where early money changers sat to conduct business with customers. Banks act as middlemen between people who have extra money and people who need money. They collect savings from depositors and use those funds to give loans to businesses and individuals, helping money move through the economy productively. For example, when you deposit 10,000 Indian rupees in a bank, the bank uses that money to give a business loan to a shopkeeper who wants to expand his store. Primary functions of a bank. Riaz Notes. Accepting deposits. Banks collect money from the public through savings, current, fixed, and recurring accounts for safekeeping and productive use in the economy. Providing loans and advances. Banks lend money to individuals and businesses through personal loans, business loans, overdrafts, and cash credit facilities for various needs. Credit creation. When banks lend money, that same money gets deposited again and lent again, multiplying the total money supply in the economy. Need of banking. Riaz Notes. Safe custody of money. Banks provide a secure place to keep funds, protecting them from theft, loss, and misuse, building public confidence in the financial system. Mobilization of savings. Banks collect small and scattered savings from people through deposit schemes and pool them together for productive use in the economy. Provision of credit. Banks provide loans to agriculture, industry, trade, and services, helping businesses expand and individuals meet their financial needs. Facilitation of payments. Banks enable smooth transfer of money through checks, drafts, and electronic systems, reducing cash use and increasing transaction safety. Capital formation. By converting savings into investments, banks help form capital needed for industrialization and infrastructure development in the country. Financial inclusion. Banks bring rural and weaker sections into the formal financial system, providing access to savings, credit, and payments for all. Importance of banking. Riaz Notes. Backbone of the financial system. Banking connects savers, investors, businesses, and the government, making organized economic activity possible in the country. Promotion of economic growth. Banks mobilize savings and channel them into productive investments, leading to industrial expansion, infrastructure development, and job creation. Credit creation. Banks create credit by lending money, increasing purchasing power and stimulating production and consumption, accelerating economic development. Efficient payment system. Banks provide fast payment mechanisms like checks, electronic transfers, and digital payments, reducing transaction costs and improving economic efficiency. Support to government finance. Banks assist the government in collecting taxes, disbursing salaries and pensions, and managing public debt and government accounts. Economic stability and confidence. A sound banking system manages financial risks, prevents crises, and builds confidence among investors, businesses, and the general public. Commercial banks. Riaz Notes. Commercial banks are banks that accept deposits, provide loans, and perform various financial services primarily to support trade, industry, and day-to-day business transactions. The word commercial means related to trade and business, so commercial banks are banks built to handle the everyday financial needs of traders, businesses, and individuals. Commercial banks accept three types of deposits: savings, fixed, and current, and originally lent funds only for short-term purposes. However, today they provide both short-term and long-term finance. The check was introduced as a simple instrument of exchange to reduce cash use. For example, when a shopkeeper takes a business loan from State Bank of India to buy stock, or when you swipe your debit card at a medical store, these are everyday commercial banking services. Term deposits and recurring deposits. Riaz Notes. Term deposits. Fixed period. Money is deposited for a specific period like 6 months, 1 year, or 5 years and cannot normally be withdrawn before the maturity date. Higher interest. Term deposits earn higher interest than savings accounts, ranging from 5.5% to 8% in India, with longer periods earning more interest. Emergency withdrawal. In emergencies, premature withdrawal is allowed, but the depositor loses some interest as a penalty for early withdrawal. Recurring deposits. Regular monthly saving. A fixed amount is deposited every month in the account holder's name over an agreed period until the total amount matures. Compounded interest. Recurring deposits earn compounded interest, helping the depositor accumulate a large sum gradually through disciplined monthly saving. Suitable for. This account is ideal for salaried persons and small traders who want to save a fixed amount regularly every month. Savings deposits and current deposits. Riaz notes. Savings deposits. Interest earning. Banks pay interest on savings deposits, encouraging people to save, though there are restrictions on the number of withdrawals per month or year. For small savers, savings accounts are designed for individuals with small incomes, and banks pool these funds to provide money for trade and commerce. Minimum balance. Customers must maintain a minimum balance, and withdrawals can be made through withdrawal slips or checks issued to self or others. Current deposits. No interest, no restrictions. Banks do not pay interest on current accounts, but customers can withdraw any amount at any time without any restrictions. For businesses, traders and businessmen use current accounts for large daily transactions, and account holders can use an overdraft facility within approved limits. Service charges. Current account holders pay service charges for operating the account and must maintain a minimum credit balance at all times. Overdraft and cash credit. Riaz notes. Overdraft. For current account holders, overdraft allows current account holders to withdraw more than the available balance in their account, up to an approved limit. Collateral security. Overdraft is granted against collateral security, and interest is charged only on the actual amount borrowed, not the full limit. Short-term facility. Overdraft is normally granted for 1 year and is considered a short-term credit facility for current account holders. Cash credit. For any account holder, cash credit is a short-term loan given to any account holder or even non-account holders against the security of goods or property. Interest on drawn amount. Interest is charged only on the amount actually withdrawn by the customer, not on the total loan sanctioned by the bank. Higher limit. Cash credit allows a larger loan amount than overdraft and is available for a longer period, making it the preferred option for traders. Loans and discounting of bill of exchange. Riaz notes. Loans. Against tangible assets, banks lend money for short or medium periods of 1 to 5 years against the security of movable or immovable property. Repayment method. The borrower repays in a lump sum or in installments spread over a pre-decided time period as agreed in the loan contract. Interest on full amount. Unlike cash credit, interest is charged on the full loan amount sanctioned by the bank, whether the borrower withdraws it fully or not. Discounting bill of exchange. Short-term advance. The bank buys or discounts a bill of exchange from the seller, paying the bill amount after deducting its usual discount charges. On behalf of buyer, the bank pays the seller on behalf of the buyer and then collects the full bill amount directly from the buyer on the date of maturity. Most common method. Discounting bills of exchange is the most common method used by commercial banks to advance funds to businessmen in trade. Other types of loans. Riaz notes. Personal loans. Unsecured loans given without any collateral, but they carry a higher rate of interest compared to secured loans. Credit card loans, useful for travel and daily purchases, but must be managed carefully to avoid paying very high interest on outstanding balances. Home loans, long-term loans given against the security of a house, also available for renovation, extension, or purchasing property under construction. Vehicle loans, loans provided for purchasing 2-wheelers, 3-wheelers, and 4-wheelers, with the vehicle itself serving as security for the loan. Small business loans, given to small and medium businesses to meet both fixed capital needs like equipment and day-to-day working capital requirements. Priority sector loans, special loans given to agriculturists, artisans, very small traders, and students to support the weaker and priority sections of society. Agency functions of commercial banks. Riaz notes. Transfer of funds. Banks transfer money electronically through NEFT and ArcGIS to any person or institution across cities and towns on behalf of customers. Collection of checks. Banks collect checks, drafts, Hyundais, and bills of exchange through the clearinghouse on behalf of their customers for a service charge. Utility payments. Banks make periodic payments like electricity bills and rent on behalf of customers, mostly carried out electronically in today's banking. Portfolio management. Banks buy and sell shares and debentures on behalf of customers, managing their investment portfolio and acting as their financial agent. Other agency functions. Banks act as executors, trustees, administrators, and advisors for their clients, and also assist customers in foreign exchange business. Modern functions. Digital banking. Riaz notes. E-banking, electronic banking, allows customers to access accounts anytime online and perform fund transfers, bill payments, and balance inquiry without visiting a branch. ATM services. Automated teller machines allow cash withdrawal and balance inquiry at any time of day, with modern ATMs also supporting cardless and biometric transactions. Digital payment services. Banks provide UPI, debit cards, credit cards, and digital wallets for quick, secure, and cashless transactions both in stores and online. Online fund transfer, NEFT, ArcGIS, IMPS, and international remittance services allow customers to transfer money safely and instantly between different banks and locations. Mobile wallet and app services. Banking apps and mobile wallets let customers pay bills, transfer funds, and do recharges directly from their smartphones anytime. Modern functions. Financial services. Riaz notes. Wealth management. Banks offer advisory services for mutual funds, bonds, and insurance, helping customers plan their savings and achieve long-term financial goals professionally. Merchant banking. Banks assist companies in raising capital through IPOs, provide advisory for mergers and acquisitions, and offer underwriting and portfolio management services. Risk management and insurance. Banks provide life, health, and general insurance products, helping customers and businesses protect themselves from financial uncertainties and losses. Foreign exchange services. Banks buy and sell foreign currencies, support international trade finance, and help exporters, importers, students, and travelers with forex needs. Credit and debit card services. Banks issue debit and credit cards for easy global payments, secured by PINs, OTPs, and real-time online monitoring and alerts. CRM and cybersecurity. Banks use CRM tools to personalize services and advanced encryption and surveillance systems to protect customer data and prevent digital fraud. Unit banking and correspondent banking. Riaz notes. Unit banking. Single office. A unit bank operates in a small, limited area through a single office and works within limited financial resources without spreading to other areas. Localized banking. Unit banks are called localized banks and may link with a correspondent bank in the city to carry out remittances for their customers. Popular in USA. Unit banking was popular in America, where banks were restricted to operating only within a specific city or state by law. Correspondent banking. Links small and large banks. Small unit banks in towns are linked with large banks in cities, which act as correspondents providing special banking services to them. Services provided. Correspondent banks accept surplus reserves, provide remittance facilities, and collect checks, drafts, and bills on behalf of smaller unit banks. Common in USA. This system is widely used in the United States as a support structure for small unit banks that cannot access big city banking directly. Group banking and chain banking. Riaz notes. Group banking. Holding company control. Two or more separately incorporated banks are brought under the control of a single holding company that coordinates their activities centrally. Advantages. Banks in the group can share cash reserves, enjoy economies of large-scale operations, and have centralized management for banking and non-banking units. Disadvantage. If non-banking subsidiaries in the group incur losses, those losses get transferred to the banking companies, causing financial risk to depositors. Chain banking. Common control. No holding company. Separately incorporated banks are brought under common control by a group of persons who serve as directors of multiple banks simultaneously. Independent entity. Each bank in the chain retains its separate identity and carries out its operations freely without interference from other banks in the same chain. Pre-Depression USA, chain banking existed in the United States before the Great Depression when groups of individuals commonly controlled several banks across regions. Branch banking advantages. Riaz notes. Large-scale operations. A branch bank with large financial resources can specialize in several operations and serve a large number of customers across the entire country. Geographical spreading of risk, loans, and deposits are distributed across different regions and industries, so a loss or crisis in one area does not affect the whole bank. Economy and cash reserves. Cash can be transferred between branches as needed, so individual branches do not need to hold large separate cash reserves independently. Remittance facilities. Since branches are spread across the country, transferring funds from one branch to another is easy, convenient, and costs much less. Equality in interest rates. By transferring funds from surplus areas to deficit areas, branch banking helps maintain uniform and stable interest rates across the country. Greater public confidence. A bank with large resources and a wide national network of branches commands greater confidence among depositors, businesses, and the public. Branch banking disadvantages. Riaz notes. Difficulty in management. As branches expand, supervision and control becomes difficult, creating red tape, delays in decisions, and administrative problems for the head office. Possibility of monopoly. Large branch banks may come to dominate the entire banking business of the country, eliminating competition and harming the public interest. Unnecessary competition. Branches of competing banks concentrate in business areas and compete for deposits, increasing expenditure and creating unhealthy rivalry among banks. Expensiveness. Maintaining many branches with trained officers, supervisors, and customer-friendly infrastructure involves very high operating and administrative costs. Transfer of rural savings to cities. Savings collected in rural branches are often sent to urban branches for investment, denying development funds to backward rural areas. Note: commercial banks in India are classified as scheduled banks, listed in RBI's second schedule, and non-scheduled banks, outside the RBI schedule. Watch Part 2 for more on banking law and practice. Subscribe to Riaz Notes. Riaz Notes.